Hey everyone, welcome back to Corporate Decoder, the place where we break down financial reports so you don't have to. And let's just say BNY Mellon Investment Fund 6 had quite the report for us this time, revealing some interesting tidbits about their balanced opportunity fund. We're diving into their latest shareholder report, a look at their portfolio as of May 31, 2025. Forget the jargon, we're going to uncover what these numbers really mean for the fund and its investors. First up, let's talk about costs. For Class A shares, a $10,000 investment meant around $57 in cost for the last 6 months. That's a little over 1%. For Class C shares, it was a bit higher at $94, almost 2%. And for the Class I and J shares, it was about $45, less than 1%. This shows how different share classes can have quite different cost structures for investors. Now for some key numbers. As of May 31st, the fund was valued at $273 million. They held 458 different investments. And the portfolio turnover rate was 29.21%. That turnover rate tells us how often they're buying and selling investments within the fund. A lower rate can sometimes mean a more buy and hold strategy, while a higher rate suggests more active trading. Let's dig into the actual investments. The fund had 30% in bonds and notes. Digging deeper, they held a significant amount in US Treasury securities at 9.5% of the portfolio. For example, they had US Treasury bonds with a 4.75% coupon maturing in 2041 valued at nearly $3 million. They also had US Treasury notes with a 4.75% coupon maturing in 2041 valued at nearly $3 million. They also had US Treasury notes with a 4.75% coupon maturing in July of this year, valued at over $3 million. They also had US Treasury notes with a 4.75% coupon maturing in 2041, valued at nearly $3 million. They also had US Treasury notes with a 4.75% coupon maturing in 2041, valued at nearly $3 million. The biggest chunk, a hefty 61%, was in common stocks. Within this category, information technology was a significant area, making up 5.3% of the portfolio. They held Microsoft Corp shares valued at over $7.5 million. Amazon.com Inc. was also a major holding, valued at over $1.2 million, and Johnson & Johnson at over $2.2 million. And Johnson & Johnson at over $2.2 million, 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 and Johnson & Johnson at over $2.2 million. Looking at specific bond holdings within the bonds and notes section, they had Nvidia Corp SIN NCD, notes with a 370% coupon maturing in 2050, valued at over $500,000. This shows their investment strategy spans across different asset classes. Digging into the portfolio holdings, it's clear they have a diversified approach, investing across various sectors and types of securities. They hold everything from well-known tech giants to bonds issued by government agencies and even some municipal securities. The total value of their investments as of May 31, 2025 was over $276 million. This slightly exceeds the book value, indicating positive market performance on some of their holdings. Looking at the fund's assets and liabilities, their total assets were over $278 million, while liabilities were much smaller at around $4.8 million. This resulted in net assets of over $273 million. For Class A shares specifically, the net asset value per share was $23.72. Class C shares were at $23.53 and Class I shares at $23.56. This difference in net asset value per share across classes is important for investors to understand. In terms of operations for the 6 months ending May 31, 2025, the fund generated over $3.4 million in income, primarily from interest and dividends. Expenses totaled over $1.7 million. After accounting for a reduction in expenses due to an undertaking, their net expenses were around $1.5 million. This resulted in net investment income of over $1.8 million. However, when we look at realized and unrealized gains and losses, the picture changes. They experienced a net unrealized loss of over $13.4 million, which combined with realized gains led to an overall net realized and unrealized loss on investments of over $7.3 million. This ultimately resulted in a net decrease in net assets from operations of over $5.5 million for the period. It's a reminder that while income is important, the overall market performance heavily influences fund results. Looking at the changes in net assets, we see that shareholders reinvested over 517,000 shares for Class A shares during this period, which is a positive sign of continued investment by existing shareholders. For Class A shares, the total return for the 6-month period was a negative 1.77%. This is not annualized and reflects the market conditions during that specific half year. The expense ratios are quite interesting. For Class I shares, the net expense ratio was 0.90%, which is quite competitive, especially considering as the report notes. This includes a reduction in expenses due to an undertaking and a reduction in fees due to earnings credits. This means the fund advisors are actively managing costs. Interestingly, the ratio of net investment income to average net assets for Class I shares was 1.55%. This shows that despite market fluctuations affecting the overall value, the income generated from the fund's operations was still positive on a relative basis. For Class Z shares, the total expense ratio was 1.09%. While slightly higher than Class I, it's still within a reasonable range. And again, note the details about expense reductions that might be in place. The notes to the financial statements provide crucial context. For instance, under Note 1 about significant accounting policies, they explain their approach to fair value measurements and how they categorize investments based on the inputs used, such as quoted prices in active markets. This transparency is a good sign. They show that a significant portion of their investments, over $180 million, falls into level 1, meaning they are valued using unadjusted quoted prices in active markets. This is generally the most reliable valuation method. Another $96 million are in level 2, which rely on observable inputs. They also report investments in affiliated issuers totaling over $11 million. This includes investments in money market funds managed by their own affiliates, which is a common practice for fund companies to manage cash efficiently. A major section details the board's process for approving the investment advisory contracts. They thoroughly reviewed services provided, compared performance and fees against peers, analyzed profitability, and considered economies of scale. This rigorous process is vital for investor protection. The board concluded that the profitability for the advisor was not excessive, a key factor in ensuring that management fees are reasonable. This is an important check and balance in the fund industry. Overall, the BNY Mellon Balanced Opportunity Fund report shows a fund with a diversified portfolio, investing heavily in common stocks across various sectors like technology and healthcare, and also holding a significant portion in US Treasury securities. While the 6-month period showed a negative return due to market conditions, the report highlights efforts to manage expenses and the rigorous oversight by the board to ensure fair practices. The key takeaway is that while the fund aims for a high total return, investors need to be aware of market risks and the impact of macroeconomic factors on the fund's performance as shown by their unrealized losses. It's a mixed bag with solid operational management, but a challenging market environment impacting overall returns. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.